Hello, in this video we'll learn more about statutory liabilities that may lead to convictions for crimes, primarily under the Securities Act of 1933, as well as the Securities Exchange Act of 1934. Auditors may have legal liability under the Securities Act of 1933 and the Securities Exchange Act of 1934. Section 32A of the Securities Exchange Act of 1934 provides that any person who willfully violates any provision of the Act can be charged with a crime. Section 15B4 authorizes the SEC to seek civil administrative penalties against any person who willfully violates certain provisions of the securities laws. The term willful often is influenced by the context of the situation. Let's start with the Securities Act of 1933. The stock market crash of 1929 began on Black Monday, October 28, 1929, when the stock market decreased by 10% in heavy trading. Ultimately, the stock market would decline 89% from its highest point in 1929 over the coming 3 years. Banks failed, and the Great Depression began in 1929 and ended in 1941 with the entry of the U.S. into World War II. In the end, the stock market recovered, but it did not do so until 1954. The Securities Act of 1933, also sometimes called the Truth in Securities Act, was passed to protect investors by providing accurate financial statements and to prevent fraud, deceit, and misrepresentation in the sale of securities. President Roosevelt signed the legislation into law and said that the Securities Act would correct some of the wrongdoings that led to the past exploitations of the public. The Securities Act of 1933 regulates the initial public offering, or IPO for short, of securities through the mail or interstate commerce. The Act requires that companies register with the Securities and Exchange Commission, or SEC for short. Companies must also file registration statements, the forms S1, S2, and S3, and prospectuses, which contain financial statements that have been audited by an independent CPA. This prospectus is available on the SEC website and must contain a description of the company's properties and business, the securities that are being offered in the IPO, information about the company's executives, and the audited financial statements. Accountants who assist in the preparation of the registration statement are civilly liable if the registration statement contains untrue statements of material facts or omits material facts required by statute or regulation, or omits information that, if not given, makes the facts stated misleading. Securities purchasers can sue the issuing company and others, including auditors, for losses suffered by third parties when false or misleading information is included in a registration statement. If the plaintiff can prove that damages occurred and there was misleading or false information, it is considered a prima facie case, which means that it's sufficient enough of a case, and the burden of proof then shifts to the accountant. The accountant can then use the materiality defense or the due diligence defense to avoid liability. So let's talk about the materiality defense next. An accountant might argue in their defense that the false and misleading information was not material, and therefore should not have influenced the purchaser's decision to purchase the securities. What is material and what isn't, though? Our textbook describes the term as the kind of information that an average, prudent investor would want to have to make an intelligent, informed decision whether to buy the security. If correctly stated or disclosed, the information would have deterred or tended to deter the average prudent investor from purchasing the securities in question. Facts that tend to deter a person from purchasing a security are those that have an important bearing upon the nature or condition of the issuing corporation or its business. Major opinion of the U.S. Supreme Court on March 24, 2015 in Omnicare Inc. versus Laborers District Council Construction Industry Pension Fund changed the legal precedent for the circumstances under which an issuer of financial statements can be held liable. Prior to this case, the Sixth Circuit Court held in its 2013 decision that a Section 11 plaintiff would only need to allege that an opinion in a registration statement was objectively false. The Supreme Court ruled a statement of opinion in a registration statement may not support Section 11 liability merely because it's ultimately found incorrect. The court stated that a sincere statement of pure opinion is not an untrue statement of material fact, regardless of whether an investor can ultimately prove the belief wrong. In addition, the court stated that the issuing company does not need to disclose every fact, cutting the other way, against an opinion because reasonable investors understand that opinions sometimes rest on a weighing of competing facts. When the issuing company gives an opinion, as long as the issuer believes it to be true, Section 11 legal liability will not survive. So, what does the Omnicare ruling mean in terms of the auditor's liability under Section 11 of the Securities Exchange Act of 1933? There are really only three circumstances under which an auditor can be held liable under Omnicare. The first circumstance is if the auditor has expressed an opinion, but the auditor does not actually hold that opinion. The second circumstance is when the opinion the auditor expressed contains an embedded statement of facts that is misleading, or if the opinion omits a fact that makes the opinion misleading to an ordinary investor. Aside from the materiality defense, auditors can also use the legal concept of the due diligence defense to defend themselves against liability under Section 11 of the Securities Act of 1933. This defense allows auditors to argue that they conducted a thorough and reasonable investigation into the financial statements and disclosures contained in the registration statement for the securities they audited. To successfully use the due diligence defense, the auditors must be able to demonstrate, one, that they conducted a reasonable investigation into the financial statements and other information included in the registration statement. This involves, for instance, demonstrating that they exercise the level of care and diligence that a prudent and competent auditor would have done under similar circumstances. Auditors must also show that their investigation was carried out in good faith, with honest intentions, and without any fraudulent or deceptive practices. Auditors should demonstrate that they possess the requisite expertise, competence, and knowledge necessary to perform the audit, and that they complied with generally accepted auditing standards or other applicable professional standards. Auditors are typically required to maintain thorough documentation of their audit procedures, findings, and conclusions to support their due diligence defense. But even if the auditors meet these criteria, the due diligence defense is not an absolute guarantee of immunity from liability under Section 11. It's ultimately up to the courts to determine whether the auditor's efforts were sufficient to qualify for this defense. If it's determined that the auditor did not meet the required standards of care and diligence, they may still be held liable for any material misstatements or omissions in the registration statement. President Franklin Roosevelt signed the Securities Exchange Act of 1934 into law on June 6, 1934. The focus of this act is on regulating securities trading, exchanges, and market participants in the secondary securities market. Some of the key points of this act are the creation of the SEC, regulation of subsequent trading, and ongoing trading of securities sold on U.S. stock exchanges. An important part of the Securities Exchange Act of 1934 is also that entities having total assets of 10 million or more and 500 or more stockholders are required to register under the Securities Exchange Act. The legislation also requires ongoing filing of quarterly filings, the 10-Qs, and annual reports, the 10-Ks, as well as the Form 8-K whenever a significant event takes place affecting the entity. The form and content of the 10-K and 10-Q filings are governed by the SEC through Regulation SX and Regulation SK. In addition to these two regulations, auditors must be familiar with financial reporting releases, which express new rules and policies about disclosures, and then staff accounting bulletins, which provide unofficial but important interpretations of regulations SX and SK. The liability of auditors under the Act often centers on Section 10 and Rule 10b-5. Under Rule 10b-5 of the Securities Exchange Act of 1934, it's unlawful for a CPA to employ any device, scheme, or artifice to defraud, make an untrue statement of material fact, or omit a material fact, or engage in any act, practice, or course of business to commit fraud or deceit in connection with the trading of the stock. The plaintiff, on the other hand, must prove that there was a material, factual misrepresentation or omission, that the plaintiff relied on the financial statements, that the plaintiff suffered damages because of the reliance on the financial statements, and that there was an intent to deceive, manipulate, or defraud. Section 18A establishes civil liabilities for false statements or omissions in documents filed with the Securities and Exchange Commission or in connection with the purchase or sale of securities. If a person acquired a security and relied on false and misleading statements, they may have legal recourse against the person responsible for those statements. Section 18B further specifies that individuals who sign registration statements, directors, partners, and officers of companies can be held personally liable for false statements or omissions in those statements. Now, if a legal case is brought against the auditor's liability can be limited if the auditor can show that she acted in good faith and had no knowledge that such statement was false or misleading. However, some courts have ruled against the auditor's good faith defense when the auditor had been found to be grossly negligent.